The way to solve problems is to have as many perspectives as possible, as much expertise as possible in terms of understanding the boundary conditions and how things operate. And I think the new thing that also kind of correlates to that is just being able to connect the dots and how one crisis, I think, as you said earlier, one crisis can lead to another one. And one tipping point can potentially trigger something else.
Welcome to Off the Desk on Tradeweb. I'm Kerem Makanal, Managing Director and Global Head of Emerging Markets at Tradeweb. In today's episode, I'm speaking with Mo Grime, Head of Global Macro at Point72, to explore how a career built in emerging markets shaped his leadership and approach to risk in today's global landscape. From crisis management lessons learned in areas such as Asia, Russia, and Turkey to evolution from managing risk in emerging markets to global macro head, we unpack the insight and future outlook that define the modern fixed income trading landscape and risk management in global markets. I hope you enjoy the conversation. Mo, thank you very much for being here with us at the Off the Desk. It's great to have you here for this session.
Great. Thank you for having me, Kareem. Nice to see you.
Would you like to introduce yourself a little bit to us?
My name is Mo Grime, and I look after the macro business at Point72. Point72 is a multi-manager platform. We were managing over $37 billion globally, and we have over 2,900 employees in 18 cities across 4 continents. I lead the macro business, but we are also in other businesses. We are in long-short, the long-short fundamental equity business, which is our DNA. And we also have a business focus on systematic strategies, which is branded Cubist. In macro specifically, we have all of the macro product, as you know well, FX, rates, government bonds, corporate bonds, CDS indices, mortgages, futures, select commodities. And I joined about 5 years ago. It's been very exciting.
Wow, it's amazing. So we have known each other for almost 25 years now, and your origins is, like me, emerging markets. So you have grown up in different countries, have been in Morocco, then in France. And how do you think this uprising in these different countries have shaped your career to where you are right now, to bring you where you are?
Well, right back at you, almost mirror image, right? You grew up in France and Turkey, and I think you speak one or two more languages than I do. And in fact, we met, I don't know if you remember, but we met in Istanbul, our first meeting, right? You were working for Credit Suisse, trading Turkey in Istanbul. So I think that answers the question right there. The reason why you joined Lehman Brothers back then, and we were super excited to have you, is because you knew the local markets. Not only you spoke the language, but you spoke to the local investors. You know how local politics work, you know how local investors, pension funds, banks, as well as the instruments, how they settle, how they trade, how they clear. So having that expertise in emerging markets is absolutely key. And I know most of your team, even now, have a lot of diverse background, and you travel a lot across local markets in Latin America and Asia and so on. So having the background of knowing the local markets in specifically emerging markets, which are, I think, unique, helps a lot, as you well know.
I agree. I mean, it's so fragmented, and one product doesn't fit everybody, and getting to different countries, understanding culture helps. You have started in managing EM risk, and now you're in this incredible position managing DM. And do you think that your experience in EM has shaped your ability to expand it to DM?
Yeah, I think the upbringing in emerging markets and trading in emerging markets, I think definitely gives you a more complete picture. So a few dimensions. One is the team you put around you has to be very diverse in terms of understanding different products in different countries. And you recall from our days in emerging markets, we had people from and traders and salespeople and researchers from countries all over CEMEA, Asia, ASEAN, LATAM, because the way to solve problems is to have as many perspectives as possible, as much expertise as possible in terms of understanding the boundary conditions and how things operate. And I think the new thing that also kind of correlates to that is just being able to connect the dots and how one crisis, I think, as you said earlier, one crisis can lead to another one. And one tipping point can potentially trigger something else. So I think just those being able to connect those dots, being able to have very complementary skill sets and very complementary way of looking at things, definitely it's something I think both you and I learned those skills, whether it's soft or hard, in the emerging market space. And I really do think they're very useful.
So all these the crises that we lived through, I mean, I started at the Mexican crisis, so you probably started before that. But Mexico, Asia, Russia, Turkey, and so forth, every crisis helped me to understand maybe the next one. But lately, I feel, and I've seen this after Lehman as well, that these emerging market crisis helps us really feel and navigate through the developed market crisis. Would you agree with that?
Yeah, I will even extend on that. I think just like you, I had my fair share of living through crisis. I joked a few times with few friends, like, don't follow me to whatever job I take, because the job I took at Lehman Brothers before you joined us was in August 1998. And 2 weeks after I joined, Russia defaulted, and LTCM crisis triggered, and so on. And then, of course, you were smart enough to leave Lehman Brothers before the Lehman crisis, just before I stayed there. So I was in the eye of the storm, not far from this building, in September 2008. And then I joined, frankly, this firm, Point72, at the end of Feb 2020. And by the time I kind of managed to meet some of my colleagues, we were sent to work from home because of the COVID crisis in 2020, in March 2020. So I really like living through a crisis. I know that's not what one wants, but I don't mind it because it's a good learning curve. It's a good learning experience. And it's really during a period of crisis where you realize if you're calm or not, if you're, and especially if you lead people, if you have a team, like in your case, working for you, that's where they look up to you, like period of crisis. And that's where you have to be calm. You have to take a step back. You have to think about the big picture and really lead by example. And that's super useful, I think. It's very useful in this day and age and what's happening right now, where we have a lot of geopolitical risk and elections risk and things of that nature that now we're experiencing in some of the developed market, not only emerging markets.
I feel like these political crises are very similar to political crises we had in emerging markets. I find it very helpful to have lived through. How's your day-to-day at Point72 at the moment?
It's similar to the way we operated when we worked together. So broadly, there are three things that kind of I will do a little bit of in a given day. One is risk management, just looking at the risk, both micro and macro, like specific country, specific markets, specific products, specific portfolio manager, or macro in general. So risk management is definitely a big one. Then the second one is people. It's recruiting, it's coaching, it's managing performance, and we have a global team just like you do. So it's challenging with time differences and time zones and so on. The third one is not losing sight of the big picture. It's good to look at the risks today. It's good to try to recruit someone today, but also you want to think about the business 5 years from now and think about how sustainable this business and try to think ahead in terms of technology, in terms of sustainability of the business, in terms of new products, new ideas.
Yeah, you still travel a lot?
Yeah, not as much as you. I do. We have we have macro in about 10 locations globally, including Sydney. And we have a great team globally. We went from a dozen portfolio managers to over 55 now across a lot of different products. So you do have to travel, because nothing can replace the the in-person, the face-to-face, but not as much as you do.
Sometimes just being in the country, like talking to the cab driver, if you speak the language, gives you some tips on the economy, really.
Yeah.
I mean,
100%, yeah.
so you spoke about the future, your investments into, I guess, infrastructure and people. Where do you think we're going to be in 5 years' time? Where do you think the emerging market is going to be in 5 years' time as well?
A number of products in emerging markets have become very similar to what we are used to in developed markets. Indices and information travels faster, and obviously there are a lot of platforms now that give you real-time translation, AI tools, and so on. So these are things you and I didn't have in the past, where we had to rely on speaking to a local reporter to really get sense what's going on with some delays. My view, the US dollar theme, kind of weakening dollar, is likely to continue as overseas investors hedge their US assets. So I think the trend for the dollar is likely to continue down. It's already come down quite a bit, about 10% from peak. The other one is, which will be good for emerging markets, because most emerging markets have dollar debt.
Yep.
On the other hand, I think the deficit in the US, but also in other developed markets, and the increased spending and the increased issuance of government debt in the developed markets will likely continue to push rates higher, especially in the long end. And that usually higher US rates is not good for emerging markets. So it's a mixed, it's a mixed basket. I think the other one that is absolutely critical for emerging markets is you had this theme of globalization that was in full impact when you and I were trading, and much later, where companies were solving for the cheapest product, the most efficient way to get the product to the consumer, and global supply chains being very optimized. I think that trend has reversed and started reversing probably about 10 years ago around the Brexit, and really accelerated during COVID when supply chains were challenged. And certainly with the recent elections in the US, with tariffs. So when globalization happened, that was good for the consumer. It was good for companies because it minimized cost, maximized margins. It was really good for emerging markets because it created a lot of employment toward the export sector. And it was not good for the domestic manufacturing business in developed market like the US. With the reversal of that trend, I think what I said about the labor markets in emerging markets, I think it's likely to hurt emerging markets from a labor perspective. So you have positive on the dollar, potentially negative on US rates, and potentially negative on unemployment in emerging markets. So it's a mixed. I think there'll be winners and losers. Some countries definitely stand out as potentially big winners.
Looks like we have always been hoping, all the trends for emerging markets to one day become developed market. I feel like some developed markets are becoming more emerging market these days, and we have seen in other big companies as well a lot of emerging background people leading big banks or like big firms, like investment firms like yourself. So it looks like an emerging market background helps the quest for success in DM as well at this moment.
Totally, yeah. I mean, I remember, back then, elections really mattered in emerging markets, and they didn't really matter that much for markets in developed markets, but they were very, very critical, very important for emerging markets. Now it's almost a reversal. And when you see all the elections we've had in the US, but also recently in Canada, Brexit was, I think, the first one where you have a major shock from a geopolitical perspective, but also other elections throughout Europe. It really matters in terms of the direction of the market and and the framework of how to think about fiscal spending and even monetary policy in some countries. So I think what's used to apply almost as a blanket setup to emerging markets has really migrated to select developed markets. And on the other hand, some emerging markets have really stabilized and have almost graduated where, think about some of the countries you traded when you were in seat in Central Europe. They've really become very, from an event risk and geopolitical risk, they've become quite stable and predictable. So the uncertainties was increased in developed markets, and uncertainty has definitely dropped and normalized in some of the former emerging markets.
When you think of risk management, how do you compare it between EM and DM, and what proportion of anticipation and versus reaction you would have in your job at the moment?
Well, I think it's all about risk management, and you run a variety of scenario analysis, possible scenarios, always thinking about worst case, tail risk. It's always about tail risk, left tail, right tail. And so that's really the anticipation part. But we also, from experience, we all know that the next crisis is not going to look like anything like the previous ones we've seen. So we know that. So there's an element of reacting to whatever, the market gives you. Like no one in March 2020 saw pandemic risk. Everybody was thinking about, default and devaluation and the usual things. So the next crisis is likely to be very different, but it's also always useful to constantly think about different outcomes and be prepared for the worst pretty much every day. But also, leave some to, being able to react. But again, going back to my earlier point, the key is to stay calm when you react, because you can quickly compound the crisis by being part of the crisis.
We always used to stress for price movements, but I've seen days or times where the price doesn't matter. There's no bid. You want to sell. There's no liquidity. Is that, for example, something that also happens to you, or is it something you take into account in developed markets? In EM, we certainly have to. In DM, is it something that you also take into account?
Yes, 100%. Yeah. So even in developed markets, if you have too many people doing similar things, you run into liquidity. You run into that situation where you just don't have the bid. And it's partly, and TradeWeb has done a great job there, partly because we've had a lot of migration from the sell side to the buy side, and you have a lot more people who are seeking liquidity versus those providing liquidity. So we do look at liquidity risk, concentration risk, leverage risk, in addition to just the usual market risk. But just like emerging markets, there is a limit in terms of how much concentration and liquidity you can take in any market.
With all what's going on today in the world, whether we're talking about the tariffs or the wars, geopolitical risks, and elections in different countries, how do you feel we're situated, and what more might be coming? What should we expect?
Well, I don't know where we're heading, but I do agree that we have maximum uncertainty, certainly more than any time in recent memory. One is, as I said earlier, you have this reversal of globalization, where now companies and countries are no longer solving for maximum global efficiency. They're solving for national sufficiency. Everybody wants to have within their borders, they want to have their supply chain nationalized. And so that's one, which feeds into tariffs, which feeds into geopolitical risk and elections and populism. There's obviously a major war still ongoing 3 years later in Europe. There are other potential
geopolitical risks as well.
Points of conflicts in Asia and Middle East and so on. You have global migration trends. You have the fiscal spending that has been very elevated, and COVID was part of that, but also increased spending over the last few years has compounded that risk, with many governments not really addressing the amount of debt to GDP in developed markets. So it's really an issue that we had in emerging markets, but now it's closer to home. It should create pockets of volatility, just like what we saw post-Liberation Day. But you can't, it's very hard to predict some of these events and like tomorrow or next month.
How do you minimize the correlation between the different risk takers you have? Because basically, your aim should be to minimize the correlation. You don't want everybody in the same position.
Yeah, I mean, we have all the risk management tools that everybody knows, VAR and stress and metrics and so on, like what we had when we were trading. But when you have a systemic event, you cannot, there's nothing to do about that correlation other than making sure you have very disciplined risk-taking process and that you have some guards around that. But when there is a major global event, correlation goes up always.
Yeah.
As you know, across all asset classes.
Do you have an advice that you have been given that you would like to share in your career? That's the one advice?
Well, I think one of my mentors gave me an amazing piece of advice a long time ago when I started, and he told me, don't think about what product you're doing, trading. Don't think about how much money they're paying you. Just make sure you work for the absolute smartest person. That's one, always. Two, always be the first one in, the last one out. Always count how many people beat you to it in the morning. And then three, stay humble, because there is so much you don't know that you don't know. And every time I learn something now, 20, 30 years later, I always think about that piece of advice. There's so much that I didn't know even yesterday.
I keep learning. You too. We keep learning all the time. Yeah.
Yeah.
I agree.
Makes it fun.
That makes it fun. In my opinion, the electronification of the markets is also helping, in a way, risk management, because there's a straight-through process, less human error is possible. And I remember back in the days when they first installed the FX trading platform on my desk at Lehman, it was like electronic game, like tick, 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 tick. Everything was going through the system, and I could see my risk immediately. And I'm wondering, how much technology is helping you in your day-to-day, and where do you see technology within the next 5 years as well in your business?
Yeah, I mean, I think, as I said earlier, we trade a variety of products. So there's a lot of different products. So we trade rates and credits and emerging markets and mortgages, and we do it in 20 plus countries and in 4 regions, 4 continents. So we are using more and more technology for, one, of course, execution, price discovery, booking. So it's helping us from a productivity gain perspective. It's helping us from a minimizing operational risk perspective, so that there's touchless kind of process. So there's less human interaction with tickets. So that's helping us. But it's also freeing up time for the investment professionals, for the portfolio managers, to really focus more on their business and investing, and less on worrying about doing other tasks that can be relegated to technology. So for the most part, it has been a productivity gain story, and I think it will continue into the next 5 years.
Mo, thank you very much. It was very insightful, I think, for me, and I hope for the audience as well. And thank you very much for your time and being here.
Karim, thank you so much for having me. Pleasure seeing you as always.
That was my conversation with Mo Grimet, head of global macro at Point72. Off the Desk is available on the Tradeweb website, all major podcast apps, including Spotify and Apple Podcasts, YouTube, and more. You can learn more about Mo and his work at point72.com. And to learn more about Tradeweb's emerging market offering, go to tradeweb.com.